Hello and welcome to another presentation brought to you by the Insurance Pro Blog. My name is Brandon Roberts. I am the owner of the Insurance Pro Blog, and today we're going to answer the question, what is a paid-up edition? I invite you to join us for more information at theinsuranceproblog.com. To begin today's discussion, we'd like to start with a quick review in terms of what a paid-up edition is so everybody's kind of on the same page. And to start, paid-up editions are immediately paid-up life policies. They require no further premiums to stay in force, and they have a cash value equal to whatever you put into them. So, for example, if you put $1 into a paid-up edition, you'll have $1 of cash value. They participate in the divisible surplus, which is the insurance way of saying they earn dividends, and they increase your death benefit. If we want to go back to that, $1 in also yields something like $3 to $4 in death benefit on your life policy in addition. Depends on how old you are. You may be familiar with some of the other using life insurance as an asset class type material that's out there, maybe from the infinite banking world or the bank on yourself world. And if you've read the books or listened to the videos or gone to their websites, you've probably heard them refer to a supercharging rider. This rider greatly increases the cash value of your life policy. And if you've wondered what that rider is, it is the paid-up edition rider. That's what they're using to make these policies work so much better and bring you so much more cash. And one of the ways in which they do that, in fact the primary way in which they do that, is since paid-up editions earn dividends, and those dividends can be used to buy more paid-up editions, there's a compound factor going on. Those paid-up editions earn dividends, which in turn buy more paid-up editions, which earn dividends, which in turn buy more paid-up editions and earn dividends. If you're familiar with finance and the idea of reinvesting mutual fund dividends, the same idea is at play. There's no magic, it's just typical math in terms of finance. We would be a little remiss in diving into this example if we didn't share with you some very important details that you should be aware of when you evaluate policies and different paid-up edition riders. First and foremost, they all have load fees that are associated with them. These fees will range typically at a low of 3% to a high of 10%, and the average at the moment is 5. So to illustrate that for you, if I give you $1 in a paid-up edition, the insurance company takes 5 pennies and holds on to it, and I will have 95 cents in immediate cash value. I'll earn dividends immediately on them, so it kind of washes itself out by the end of the year, but just so that you're aware, there are fees. Flexibility is a big consideration when it comes to paid-up editions. Some companies will basically tell you you will choose an amount at the beginning of the issue of your policy, and that's your amount. You can't change it. Others will allow you to move the amount that you put in terms of paid-up editions to the policy up and down within a certain range, and the wideness of that range will vary from company to company, but we would contend that it's best to have some flexibility in your paid-up rider because you want the ability to put in lots of money in years where you have the money to do it, and if you run into a tight year, you want the ability to pull back on that and not lose the rider. There are some other limitations that exist. Typically, those limitations are a factor of how much you can put in terms of paid-up edition to the base whole life death benefit, and sometimes a time limit on the amount of time that you can put paid-up editions into a policy. In other words, the rider will expire at age 65 or age 75 or so forth and so on. So you want to keep some careful attention to some of these details and ask questions about these 3 specific issues whenever you're evaluating a life policy and its paid-up edition rider. To step back for a minute and sort of give you a 3,000-foot above view rather than dive into the minutiae of what's going on and why this works and how it works, when you put money into a paid-up edition rider, you're basically giving the insurance company more money than you have to. And as a reward for doing that, they're going to take the money, they're going to invest it, and they're going to share the success that they have in making money with that money. Now, it would be fairly imprudent for someone to ask just how successful insurance companies have been in terms of investing money and earning yields on those assets. And the 30-year average for the life insurance industry on their general account has been a little over 9%. Now, that's a pretty good number. It beats the average mutual fund investor by quite a bit. But it's even more important to understand that life insurance companies are fairly tightly regulated in terms of what they're allowed to invest their general account assets in. It's primarily bonds with some cash equivalents and some highly rated low-risk mortgage obligations and a little bit of equities. There's not a lot of speculation. In fact, regulatorily speaking, speculation is not allowed directly inside a insurance company's general account. So to be able to pull off a 9+% yield over the course of 30 years is fairly impressive. And the insurance industry continues to do some very, very spectacular investment yielding, even in the wake of the most recent financial catastrophe that we have faced. To better illustrate how paid-up additions will yield for you, we borrowed this from one of the major mutual life insurers from one of their brochures. This is an example that they projected for $25,000 dump-in of paid-up additions in year 3 of a life policy. And as you can see, there's an immediate positive return, and that positive return gets quite a bit better as time goes on. Remember that when it comes to investment considerations, we are primarily concerned with 3 topics: preservation of principal, liquidity, and yield. And cash value life insurance on its own does a very good job yielding highly for its great preservation of principal and great liquidity features. In fact, it has preservation of principal and liquidity of a money market mutual fund, and yet it yields like a bond, which is very good. Throw in the fact that you have the ability to avoid paying income taxes on the money, and that pretty significantly augments the overall rate of return on paid-up additions. So if you're looking for a safe place to store your money, paid-up additions are a really great place to consider. But the real big takeaway that we want to give everybody today is simply this: paid-up additions will grow cash value inside your policy much faster than a regular whole life policy. So if you're looking to do life insurance as an asset class, please, please, please pay a lot of attention to how much of your money is going into paid-up additions and how much of your money is going into other things like the base whole life policy, the riders, and so forth and so on. It's crucial, if you're going to do this right, to have a policy that, one, is a policy focused on cash value accumulation to begin with, and two, that at least half of the money going into the policy is going into paid-up additions. This is critical if you're going to make this work the best way that it can for you. If you want to know more, we invite you to join us at the Insurance Pro blog to learn about this and several other topics. Click the link below to get all of the information. Thanks for stopping by, and we'll see you again next time.